Today I'd like to talk about the income statement. The income statement is one of the two basic summary financial documents, along with the balance sheet. What the income statement is a measure of how the company has changed over a period of time. Usually that period of time is a month or a year, but an income statement can be done over any period of time. The income statement is driven by a formula. Income minus expenses equals profit. Income is what the company gets in terms of money. Expenses is what the company pays out in terms of money. And clearly what's left over is profit. Let's look at an income statement for Waterloo Fabricating. At the top of the income statement, we can see that we have a date. But unlike the balance sheet, it's not a specific date. It's a period of time. So in this case, it's the month ending February 28th, 1990X. So it's the income and outflow over that period of time. This is a through variable. It's like a flow or current. It's money per month, if you like, as the dimensions of it. On the income statement, we can see our three basic components: the income, the expenses, and down here the profit. The profit is fuzzy a little bit because of taxes. But we'll always see those three categories. Although the particular structure of income statement for a particular organization may differ a little bit. This is perhaps typical of a manufacturing organization, which is what Waterloo Fabricating is. Now, under income, we see gross income from sales less cost of goods sold, giving net income from sales. This is a structure that's typical of a manufacturing organization, where you actually include some of the expenses in the income. It's just convention to do so. In other organizations, you might see all of the costs being down in expenses. But for manufacturing, you'll see this relationship between the sales and the cost of goods sold. But you end up with a net income from sales as income. And you may have some other income. In this case, we have some fees for services. In addition to selling their product, they may, for example, sell maintenance services to their customers, giving a total income of $62,000, or almost $63,000. Under expenses, there can be a variety of categories. We have some salaries here. These salaries would probably be sales and office salaries as opposed to manufacturing salaries, which would be up in the cost of goods sold. Depreciation, we saw depreciation of the equipment occurs as the equipment gets older. It's an expense, and has to be recognized as such. Advertising and insurance are other expenses that the company has. These particular categories often correspond to accounts that are set up in the company to keep track of expenses. Or there may be summaries of several different accounts. The total expenses are accumulated, and if the company's profitable, the income will exceed expenses. That's not necessarily going to be true over every period, but we'd like to see it true over most. And if the income exceeds the expenses, we have some profit. If the expenses exceed the income, we have a loss. Here we have a profit of almost $5,000. Now, the government has to get its share with the company, as it does with individuals, and the company's taxed. A typical tax rate, as we'll discuss when we look at taxes more closely, is around 50%. In this particular case, it's 51%. So the tax of 51% of the profit are taken off the profit to give a net profit. This net profit is what's going to contribute to the retained earnings. So the income statement is fairly straightforward. We have income, expenses, and profit. There are a couple of complications here to note. A complication with a manufacturing firm of having the cost of goods sold subtracted from the gross income from sales before it's noted as income. And the other complication with taxes, to keep track of the tax expense as part of the profit calculation. Thank you.